We have the debt problem of the very similar to what we saw coming out of the World War II. It's very elevated, particularly in the government side. We have an inflationary problem, which I don't think is going away, that is similar to the 70s perhaps. And then we have a valuation problem, periods that we tend to see highly speculative environments. And so like the late 90s, like before the Great Depression in the late 20s, we're approaching this environment in a unique manner. We've never seen this in the past. We've seen those things happen independently, but never all at once. So when you put that together, so the fiscal and the trade deficit, it's called the twin deficit. It tells you, if you're just doing the math, of how quick the debt problem in the US is compounding over time. And so the bigger the trade deficit we have, the more we need of buyers of our treasuries in the US in order to finance the country. This is a big problem because right now we are 16% of GDP on that measurement. Just to put into perspective, that is as low as it was at the very worst parts of the global financial crisis. We're not even in a recession. We're already at that level. So that is crazy concerning to me. The composition of the debt has completely changed. That's, sort of why the twin deficit is so relevant right now, because the size of the market is so large that if we're compounding things at 16% rate, boy, this is probably going to be a problem here very soon.
Welcome to the Macroscopic podcast presented by GoldRepublic. My name is Alexei Jordanov, and on this format, I invite you to look at the world through different lenses to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the nature of money with alternative assets like gold, silver, and cryptocurrencies. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. Today, I have the pleasure to welcome Tavi Costa, a well-known financial analyst and portfolio manager with a strong reputation for his expertise in global macroeconomics and financial markets with almost 200,000 Twitter followers. He is known for being candid and unafraid to challenge prevailing market narratives, which has made him stand out as a contrarian voice in the financial world. In this episode, Tavi addresses important questions to navigate the unprecedented times we live in financial markets. Is a soft landing narrative a trap? Or are we at the beginning stage of a looming recession? Why is Tavi worried about the state of treasury markets? Is higher inflation a misplaced opportunity? And what are the factors that will lead the price of gold to $10,000 an ounce by the end of the decade? Hope you get fresh insights and enjoy this conversation. If you do, please like and subscribe, leave your reactions in the comment section, and share it to those who need it. And as a little thank you gift, we'd like to give you 1 free gram of gold worth €60 if you open an account at GoldRepublic. To see more, click on the link in the description down below. Welcome Tavi. It's great to have you back on the show. It's been last time, I think, around 2 years since we have talked to each other. And a lot of things happened in 2 years. We were in the middle of COVID. We had unprecedented measures. We have also a lot to unpack today. But the first question I would like to ask you is the following. Imagine you're in a spaceship and you're approaching this macro world that we all talk about. What is on your dashboard? What is on your radar?
A lot of things are in my radar, but I think one of the most important ones is the difference between what we're seeing today relative to prior, near top of the business cycle type of settings that we've had in history, such as 06, 07, or leading up to the tech bust and other times. And, I'm trying to explain that in a way where it's a labor market is very different. We're seeing a very unusual sequence of data, in my opinion. There's a lot of people seeing this as very positive. I'm not being able to paint it that way, although positioning has been very crowded. If you look at the actual data from what companies are reporting and so forth, we're certainly seeing a significant contraction already in fundamentals of corporations. But that is also in contrast with, the strength of the labor market, which tends to be a lagging indicator. Who would have thought how much we have tightening monetary conditions, and we haven't seen, a significant shock yet at the banks. But, you would expect a lot more, especially given how levered the economy really is. And so what's in my mind is the difference between how correlations will kind of unleash themselves in this next potential for a downturn compared to other periods that we've had, like '08, especially, and other times like a deflationary shock of the tech bust as well. And there's a lot of kind of a list of things that are part of those differences. I mean, you have a treasury market that is very, very different in those times. Although we were seeing a large amount of, so think about this, as the economy has a lot of leverage, meaning a lot of debt relative to GDP or relative to the economy, what you tend to see is a large issuance of treasuries. That's how a government finance themselves. They have to issue treasuries. Somebody has to be the buyer of those treasuries. During prior recessions, we had the Federal Reserve being the buyer of last resort. We also saw other foreign central banks buying treasuries in a large way. What is unique about today is that, number one, the supply of those treasuries is so large, what we're seeing. So we're basically, it's almost like we're operating as if we were in a war, or if we were in a in the middle of a lockdown and the pandemic all over again. But we're not necessarily there. Some people may argue we're in a war now, and that's a fair argument. But in a way of the degree of how much we're spending in general is something that is, I wouldn't call it unsustainable. It could be sustainable if the Fed and other monetary authorities actually step in and become the buyer again of those treasuries, so they're not just flooding the market with those. And so those are the big differences in the mechanics of the market, because just like any, if you've got too many cars and not too many buyers, well, the price of cars is going to fall. It's the same thing happens with treasuries. If there's too much supply of it and not enough buyers, you start seeing the treasury value decline, and that causes interest rates to rise. And so, this is, and why is this different? Is because in deflationary shocks, you tend to see yields decline as part of that. And today we're seeing the opposite. And so people are confused, and they're thinking, well, maybe the yield rise has to do with the economy doing so well. And I don't think that's the case either. It's just the economy is kind of this inflection point. It has been for some time now, this kind of delayed, downturn that we haven't had yet. And at the same time, we're seeing this large amount of issuances of those instruments that is causing yields to rise. It's a very unusual, environment. I think there's a lot of good things and bad things that will come out of this. Like any change in macroeconomics tends to cause very opportunistic situations for investors. And so I'm excited about that. But I'm approaching this knowing how unique the setting really is. And I call this the trifecta of macro imbalances. Trifecta meaning, we have the debt problem of the very similar to what we saw coming out of the World War II. It's very elevated, particularly in the government side. We have an inflationary problem, which I don't think is going away, that is similar to the 70s, perhaps. And then we have a valuation problem. When you look at the excessive prices people are paying for a business that does, certain amount of sales and earnings and so forth, this is also at periods that we tend to see highly speculative environments. And so like the late 90s, like before the Great Depression in the late 20s. We're approaching this environment in a unique manner we've never seen this in the past. We've seen those things happen independently, but never all at once. And so to me, I'm glad. I'm happy to share more about the market views and how I think this is going to shape up. But that's sort of the setting that we're in. If you're really watching closely the markets.
Okay, so if I could resume it in one sentence, we have the expenditure, so the fiscal, let's say, spending of the government with the different social programs and expenditures of infrastructure and so on of the post-war era, with a lot of spending, a lot of budget. We have the inflation levels of the 70s, and we have the tech bubble-ish bubble territory of the maybe beginning 2000s, all coming together in something that we could maybe call a perfect storm or a deadly cocktail.
Yeah, I mean, it's, why is it so different is because in an environment like that, you have to think about some sectors of the economy that can actually do well in a downturn. And natural resources can do very well in a contraction of the economy because everyone's thinking about the supply side on that, or I should say on the demand side of when you have a recession, it creates a shock in a lot of those resource, across the globe. And what you tend to see in environments like we are today, given the inflationary nature, but also, the ultra conservatism of capital by producers of those supplies and so forth, we're likely to see those things actually perform okay in a recessionary environment. And they can come out of a recession much stronger than other parts of the economy. Other things that I think will perhaps even shock some viewers by saying this, because we're just conditioned to think if we have a recession, housing market would collapse or something like that. I'm not sure that will happen this time, because in order to see a housing market collapse, we need to see inventories rise. We need to see spending on construction. We just haven't seen that. And you can see that clearly on the data. It's not like a one region of the US economy or and so forth. We need to see home builders building. And surprisingly, you look at even the valuation of those companies. They're really cheap historically. And so, it tells you that a lot of businesses that are involved with tangible assets, they are extremely cheap today. And we saw that in the 70s too. Again, it's a very different environment in the 70s. We didn't see debt and other issues. But the debt is not on the corporation side, right? And the debt problem is not on the household side, like in 08, when households couldn't really, borrow money anymore. And so we had a total collapse of demand and a lot of other issues. That's not the case here. The household section is actually, their balance sheets are healthy. And this is why we're in an inflationary environment, because their balance sheets are healthy. The cost of living has risen. They're asking and demanding higher wages and salaries. That squeezes the margins of companies. So, you can go on and on and on and all those extrapolations of thesis. And it's creating a different, and then everyone is so focused on technology today. And technology, it's one part of the economy that tends to be really linked to interest rates. And we can dive into that. And I'm not sure that would be, I think there's a lot of unperceived risk in that sector of the economy, where I just don't see the risk reward of being involved with that sector at all. It's especially being so crowded and conventional, that this is going to be the next era of investing. And while I do think there's revolutionary things happening in AI, I'm not sure this is like the internet in terms of the impact of all this happening in the long term, not in the short term. So, sorry to unpack a lot of things. There's a lot of things in my mind on all this, but I know I'm trying to approach this with very, being open-minded, but understanding that this is not a wait. This is not early 2000s, and a lot of leadership of the markets can change drastically in the next 5 to 10 years.
So that's more of also like the asset side, but what I would like to focus on is maybe more of indicators of what we would say is, okay, this is going into a recession. And if it's going into recession, how deep will it be? We've seen that at the beginning of the year, in January 2023, we had all over the news, Bloomberg or whatever you would open something, analysts, everybody kind of agreeing on one thing is there will be a recession maybe this year, end of this year, or maybe next year. So maybe one of the most anticipated recession in history. Then comes the question, are we then, based on, of course, like the data that we have, employment still being strong, inflation kind of decreasing, maybe not at the levels that central banks desire, especially in the US and let's say the ECB in Europe here, to make it relatable. But then comes the question, are we in the delayed recession, or maybe could we achieve a soft landing where basically the interest rate would raise without breaking the economy? Or are we entering or are we in a silent global recession? Because the shortest gap that we've seen between the start of a tightening and a recession is usually 9 months. So we are already in that phase. And it was the last time in 1973. We're entering this territory of this delay, not delay, sorry, but the effect of tightening and higher interest rates, which often lead to breaking the economy and causing a recession. What are your thoughts on this?
Well, let's think about this. So US first for an indicator. I think the indicator that comes to my mind that is the most relevant one is the yield curve. But a lot of people tend to look at the yield curve, which is essentially just looking at, the interest rate on, the 10-year interest rate, the long-term interest rate versus the short-term interest rate, the 2-year interest rate. And when you see the 2-year, which is a shorter time, higher than the longer term, that's an inversion of the yield curve. And that tends to, the two versus stands tend to precede recession. Sometimes they coincide with recession. It's a very noisy type of indicator. So when I was really researching that back in the days, I started to realize that there's maybe a better way to approach this, which is looking at the percentage of yield curve inversion. So basically, there's not just a 2-year yield and a 10-year yield. There is a 3-month yield, there is a 6-month yield, there's a 12-month yield, there's a 1-year yield. So I get all the interest rates that are available on treasury durations. And then I take all those combinations and I try to figure out how many of those are inverted today. And then I take the percentage of that. How many of all treasury yields are inverted as of today? And that research is very relevant and also helpful from a portfolio positioning perspective, because when we go above that 70% handle, when there's 70% or plus of the treasury curve being inverted, that tends to be coinciding with a downturn in the economy. So today we have that. We're above 70%. I think the only difference is the characteristics of that yield curve inversion is very different than what we saw again in 08 in early 2000s. So think about this. Back in those times, we had 10-year yields and 30-year yields declining because of the risk of a recession. And then we had the Federal Reserve hiking rates. And so that caused inversion. Today, we're not seeing that. We saw the Federal Reserve hiking rates, as you mentioned, but all yields are rising. It's not like there's, 30-year yields and 10-year yields falling, collapsing, essentially causing this yield curve inversion. And this is very usual of a stagflationary environment that you're in. And so when you have yields being pushed higher because of the supply, because of the inflationary nature of the economy, you tend to see, despite the fact that a lot of things are inverted, it is not being caused by the fact of things being, falling. It's just because the shorter duration is rising faster than the longer ones. So let's get that behind us. I do think that that's a very important recessionary signal I would not ignore. It has never failed in the past, and it tends to cause CEOs and other management decisions to become more cautious over time. So they reduce their employment plans, they reduce their capex plans, and so because they worry about a recession risk. And so as you tend to see those decisions that leads to contraction in the economy, I don't think this time would be any different. So those are the important parts. Since the last 6 months or so, the overly bearishness in the economy has also coincided with the fact that inflation has been decelerating. And so we had base effects happen in the last, call it 12 months or so, where, when the Russia invaded Ukraine and all those things, we had a really push in commodities and all those instruments. And that was sort of the peak of inflation. Since then, we've had inflation decelerate over time. Now, we're on the other side of this today. I think inflation is one of the most mispriced opportunities in the markets right now. As a trader, putting my investor hat more short term, I think I just highly doubt that we're not going to see inflation reaccelerate. And the main reason for that is if you study history, you can look at Brazil inflationary eras. You can look at Turkey. You can look at Venezuela, Argentina, the US. All of those economies, and it doesn't matter where it comes from, the inflation develops through waves. And so you see the first wave, and then there's base effects that cause inflation to decelerate, and then it bottoms again. And we just had this deceleration process already happen in the US. So, and at a time when you look at the markets, you have a lot of people betting to a record level that the Federal Reserve is going to be cutting interest rates. I just don't believe in that at all, because if you think inflation will reaccelerate to the upside, I think there's zero chance that they're going to be doing that. And so obviously we're talking about probabilities. It's not zero chance. There is definitely a chance that inflation may not accelerate. That's not my opinion. I feel very strongly that inflation is going to start reaccelerating again, or at least bottom at where it is today. And if that's the case, it changes the dynamic of equity markets. And then, if inflation reaccelerates, well, does that mean the Fed has to hike more rates? How would the equity market behave on that environment? Probably not positive. And so the way you approach this, looking at the correlations, is in the 70s, as inflation decelerated, the market actually got some relief. And if I'm a believer that inflation will reaccelerate to the upside, which I think it's a contrarian view, I can see that by looking at the markets. I mean, if everyone is betting that we're going to see rate cuts, that means nobody believes we're going to see inflation. And so, a lot of people ask me, well, how do you believe there's going to be inflation in a recession? Well, it's called stagflation. There's a name for this, and we solved this in the past. And so I think this is sort of where we are. And your final comment on Fed funds rate and the fact that the Federal Reserve has been raising rates, I would also not bet against the fact that, in the past we've had this lagging effect on interest rates rising and having issues in the economy. I do think that that's eventually going to be the case. When I looked at the amount of interest rates increases that we had, and I looked at the volatility of the market being so suppressed, and I looked at, there's an indicator called credit spreads, which is basically looking at the interest rate that a company, will borrow their capital versus the risk-free rate, which is a treasury yield. And once you see that spread being very narrow or sometimes even inverted in some cases, it makes no sense for you to buy those extra risk instruments when, if there's a shock in the economy, the credit spreads tend to blow out, meaning, the risk for providing your capital to a corporation will increase relative to giving it to the government. And so that's what we tend to see in recessions, the blowout of credit spreads that I think some people have heard. And so I think those things are really cheap. In my mind, I'm thinking, how do I maximize my way to be, betting that volatility will rise here, or potentially credit spreads will rise. And there's different ways of kind of looking for that as a mechanism to that manifests itself during periods of contraction in economy. So, potentially caused by inflation, really bottoming and so forth. So this is really what's in my mind for the next kind of 6 months or so. I think we're going to see that materialize along with commodities bottoming and some other things, maybe oil and agricultural commodities are starting to show the already, in my opinion.
Okay, so you expect a recession in the coming 6 months?
I think it's probable. By the way, I don't have to be right on a recession call because I have to be right about where assets will go that I own in the portfolio. The calling of a recession thing is not as important for a money manager. It's important for media, but it doesn't really matter. So you can say that. I think there's a high probability inflation will reaccelerate, and then the risk of recession will rise on the back end of the year. I think there is a probability of that. But again, I'm not sure that's what really matters. Is much more. If let's just say I'm right about this inflation call, and then you start seeing, 10-year yields continuing to rise, or 10-year interest rates. And then you have on the back of that, technology companies, losing that leadership dominance that we have seen. That's a call I'm willing to take, for the next 6 months. I'm willing to say that, yes, I think that's going to happen. I think there's a risk that 10-year yields can really continue to move higher. If that's the case, we may see a decline of technology companies' dominance. I think we've seen too much of it this last 6 months or so. Very likely, we're probably going to see some of that not keep up. I'm willing to take the risk that oil is going to be an interesting trade in the following 6 months or so, and that is mostly being thinking about what's happening with how tight the supply is of oil, but also that the Federal Reserve or the government has been selling their strategic petroleum reserves, and they're already at 1980 levels. And so sorry, I'm not trying to skip the question of is there a recession or not. I have no shortage of views in the market, that's for sure. But I just don't think that's a relevant question for a money manager as relevant as, I'll give you a very short example. 1990s, there was a recession. There was SNL crisis. If you bet against the market at that time, all you got was a 20% decline. That's it, and, a lot of people thinking, wow, there's a whole crisis coming in from savings and loans and institutions and all that. We're going to see a 40-50% decline during the middle of another recession and so forth. And guess what? We didn't. And so, to me, it's a lot more important to understand the asset price behavior than the actual calling of a recession or not. But I think the risk of a recession increases.
What I find actually interesting is also to assess if there's a downturn, how heavy it will be. I mean, depending on where you look or based on the videos you watch or the news you read, there's always two spectrums, the more optimistic and the more pessimistic one. Some on the pessimistic side say, we're about to approach the biggest crisis we've ever witnessed with, let's say, just to make it simple, with the three components we've just mentioned about post-World War expenses, 70s inflation, and tech bubble of 2000s. That would be like, let's say, the more pessimistic side, total chaos. And then there's a more optimistic one, which is about, the fact that, we might have a recession. It's going to be pretty mild, but then it's business as usual. What is your point of view then on looking really at the health of the system as a whole?
Well, looking at specific sectors, for instance, I think it's very, let's just say, give an example. if there is a contraction in the economy and we do see, let's say, housing market also get impacted, so the demand shock is so large that, house prices decline 15, 20%, I would be a huge buyer of that because I understand the underlying structural problems in the housing market are not there to sustain a further sell-off, especially given the fact that I believe so strongly that 10 years from now, construction costs is going to be higher, not lower. So that sector of the economy, to me, doesn't have a lot of downside to go, right? I mean, I just don't see it. Oil, I don't see oil, going back to $40 or $30, a barrel if we see a recession today. I think we've already seen a 45% decline in oil, and seems to me it's bottoming at around $70, $80 a barrel. So that's something unusual, right? That's something that further exacerbates the degree of a contraction that you were asking. So those are two parts of the economy. I don't think we'll see that. Copper, if you're in the copper industry and so forth, supply is so tight and we're seeing so much demand for construction that I just don't think that even in a contraction of we're going to see a large decline in copper prices. So even that part of those industries are probably going to be fine. Now, you asked me about technology and all those things. Yeah, I think that there is a very high risk on those companies. It wouldn't surprise me if they go down some crazy numbers. It wouldn't surprise me if the interest rate environment kind of leads the way to investors thinking that that technology and the whole sector shouldn't be the most attractive part of the economy anymore. And if that's the case, it's a big shift because think about, it's over 50% of the weight of the economy is on technology. So, that can be a huge impact in the overall market. And so I'm very focused on that. I think that the overall market is we're going to see a lot of things rotating. And so when I looked at an index, let's just say the S&P 500 or NASDAQ, which are heavily weighted on technology, yeah, I think there is a potential for a much larger decline than people believe if there is the development of those things. But I think it's even easier to bet against individual companies that are kind of in that. And it's not really betting that they won't work. It's just I think that the volatility price in the market for those specific companies, the Apples and Amazons and Microsofts and the mega cap names, are just unjustifiable if the environment that I believe we're going to be in 6 months or so really unleashes. And so I think there's I'm not as bearish as a lot of people. Like I don't, I as far as a Great Depression or anything like that. I don't think that that's going to be the case either. I think the likelihood is more of a stagflationary environment that continues to develop. And if that's the case, if you think about the Fed's options here, it's really allowing inflation to run hotter than historical standards, or really tightening monetary conditions very, very tight, creating a financial shock that then creates a potential a real deflationary problem, which I don't think that's the route that I think they would pick. And so if I'm in that camp, I think this is going to be highly inflationary, or at least allowing inflation to run hotter, and inflation will do its thing. It's going to be on waves. But if the Fed allows it to go to be hotter than expected, then it's much more of a rotation in the market than anything. But it's hard to believe that an index is going to do very well in 5 years from now because it's so heavily weighted on technology. So, I almost think that this is not a broad problem. I don't think it is. I think the problem is government related, very specifically, meaning the amount of debt in the government and how much they are compounding the debt problem over time because of the fiscal stimulus. That's a huge issue. The technology section is also, the segment of the market that I'm very, very concerned. I think we could see a tech bust kind of environment where some companies decline, over 40, 50% or 70%, depending on the case. I think that's very possible. But yeah, I don't know. It's that's sort of in my mind. And then I have other things that are, gold could be kind of an incredible way to protect capital over time, which is completely unusual for a lot of people because they have short-term memory and they're thinking about '08 and how gold got completely demolished during that period. And I don't think that that's also going to be the case at all, because during stagflationary environments, gold actually is a real haven asset. And so, that's also going to be very confusing for a lot of people. I hope it's not going to be confusing to me. I'm expecting gold to do very well in the middle of a downturn.
Mm-hmm. We're going to get to that, but I think you've mentioned also some interesting points about more the government-related issues. And you've also published every month with Crescat Capital those investor letters, and in one of the latest letters, you've also pointed out the one actually of July, and I printed it here. It's right here. You talk about mainly this fiscal spending, so basically how much government spent. And there's one chart where you show the US twin deficit to GDP. Maybe it would be interesting for the listening viewers to understand what this actually means and what it also implies on what we talked about, the fact that our system is really leveraged with so much debt, and what this does basically to the economy.
Well, so there's two parts of this question. So basically one of them, let's just start with the fact that a country is very similar to a corporation in the sense where you have ways of getting your capital, right? Just meaning you can sell a product and receive a profit or a revenue on it. And so when you think about the government as a corporation, it's much easier. The government, they, just like a company, they invest on things and they also receive capital in two channels. The two channels are taxes. They receive taxes from corporations, individuals, and so forth. That's the collection of revenues that comes from the government side. And the second way that the overall country, not the government, the overall country receives capital is through their trade surplus or deficit, meaning if they are exporting more than importing, that tends to bring capital, obviously, to your country if you're exporting more. The problem is the U.S., given the fact that is the reserve currency of the global economy, has been running a trade deficit for a long time, meaning they import more than export. And that is okay until you start seeing the degree of government spending that we're seeing. So let's just look specifically on the government side, tax collection, fiscal spending. You look at tax collection, it's at recessionary levels. It's declining in a large way, which goes back to the idea of a recession. I mean, that every time we've had a decline of tax collection like we're seeing today, that tends to be aligned with a recession as well. So keep that in mind. So that's rolling over. Then the other side of it is just fiscal stimulus, how much they're spending of capital on different things. There is social programs happening. There's Social Security and so forth, Medicare, Medicaid. You've got interest payment. So you got the debt and there's interest and you have to pay on that. You've got manufacturing plants. You got green revolution, all sorts of things, military spending that create this fiscal agenda. And if you look at that, it's rising in a very significant way. So today, that accounts for about 25% of the economy right now. It's a very significant number because it's larger than what we saw coming out of the global financial crisis. It's larger than any other time in history, unless you compare with the COVID problem, where we went to 30+%, okay? So then you may say, well, Tavi, but a lot of that fiscal spending is related to the interest payment. No, it's not. Although interest payment will likely become a very large problem, it already is. It's about 3% of GDP. If you take that out of the equation, if you exclude interest payment, we're also at about 23% of GDP on fiscal spending and rising. And so the government's spending capital like crazy right now. At the same time, if you look at the trade deficit, is getting worse. We're importing a lot more than we are exporting for many reasons. One of them has to do with oil, and there are other situations that are causing the trade deficit to worsen drastically in the last 12 months or so. So when you put that together, so the fiscal and the trade deficit, it's called the twin deficit. And essentially, why is this so important? Because it tells you, if you're just doing the math, of how quick the debt problem in the US is compounding over time. And so the bigger the trade deficit we have, the more we need of buyers of our treasuries in the US. I'm Brazilian, but the treasuries in the US, in order to finance the country. Okay. So this is a big problem because right now we are 16% of GDP on that measurement. Just to put into perspective, that is as low as it was at the very worst parts of the global financial crisis. We're not even in a recession. We're already at that level. So that is crazy concerning to me. The other thing is, if you zoom out and look at that chart, you're going to see that, going back to the tech bust and the global financial crisis and then the COVID crisis, what you find is that each of those contractions, we saw a lower twin deficit. And so, and the tech bust was it reached a low, and then global financial crisis went even lower, and then the pandemic crisis went even lower. I think it was negative 30% or something. And today we're 16 without seeing a recession just yet. And so very likely this is a structural problem, meaning we're in a secular decline of twin deficits over time as well. Why is that so important? Well, that's negative for the US dollar. Very negative. I mean, if we are indeed in a period where twin deficits are just going to get worse over the next 3 to 5 years, then you don't want to be long the dollar, especially relative to tangible assets. And that's because historically there's a link between the dollar and twin deficits, where when twin deficits fall, you tend to see the dollar fall as well. So those are the issues that we're seeing regarding this. That I think are important. Lastly, one thing that is important is looking at the debt component today, because we're looking at the compounding effect of that. Now let's look at the actual problem, the debt issue. And, you look back, in 2008 or so, what we had is the composition of the debt was really driven by household debt first, a lot of corporate debt, and a smaller section for government debt. If you look at that picture in 2008 versus today, after the COVID problem and so forth, which caused a lot of those changes, when COVID happened and the economy got in a lockdown, the government said, okay, we're going to take on more debt, and then we're going to provide that capital to corporations and households so they can sustain their problems for now. And as we see that, most of the folks that receive capital, they pay down their debt, they use their capital in different ways. And so you had a deleveraging process of corporations and households. Believe it or not, but this is on the data. This is factual. And then what you had, in order to finance that, you had the government debt surpass the levels that we've had seen in other periods in history. It got to levels like we saw in the World War II, as we said in the beginning of the interview. So the composition of the debt has completely changed. And it's why the treasury market is becoming more and more relevant, because the size of that treasury market is so big relative to other times in history. And so that's, sort of why the twin deficit is so relevant right now, because the size of the market is so large that if we're compounding things at 16% rate, boy, I mean, this is probably going to be a problem here very soon. And so this is why I'm very concerned about the treasury market in other parts of the economy.
Mm-hmm. Very interesting. what also occurs to me that you triggered me on a couple of things here. First is the role of the US dollar as a reserve currency, and thereby also like if this is something that is unique to as a unique problem to the US dollar slash, let's say when you look at the twin deficit maybe for the euro or for the yen or other currencies, that would be, let's say, my first angle. But on the other hand, I would like also to maybe focus more on the treasury market as a whole. So government debt is now at all, like we've never seen those levels before, right? In terms of debt to GDP, in terms of also global debt, I think just recently we've surpassed the world debt reached record high levels of $225 trillion, I think. So the world is heavily indebted, and more and more governments also try to compensate by raising money through those instruments. But at some point, this might not be possible anymore, because, as you mentioned, we have higher and higher interest rates for all kinds of treasuries at all kinds of durations. And this is not just the US, it's kind of also a global phenomena. Correct me if I'm wrong. And thereby comes the question, is it still a safe market, the bond market? Because we've seen in the 2000s the problem with the housing market, saying, yes, the housing market is one of the safest markets ever, so there shouldn't be any problem. Now we consider the bond market as one of the safest and the most important market in the world. Would you say that the bond market is in that sense also at risk as a whole, structurally speaking?
I think so, although this is unsustainable, right? I mean, we can't just allow interest rates to rise substantially and continue to see the debt problem worsen as much as it has been, but mostly then at some point caused by the large size of interest payments that we're going to have. And so understanding that, a lot of people look at that scenario and think, oh, wow, then I should be buying treasuries because the government at some point is going to have to step in. If the logic or the rationale to buy treasuries is on the premise that interest rates cannot sustainably rise, otherwise we're going to have a system break, then I don't think treasuries are the best way to capitalize on this. In fact, I think gold is a far superior alternative for that. And I think central banks are starting to realize that. When you ask the question about the dollar and the dominance of the dollar, yeah, I mean, this is, don't think it's the end of the dollar. It could potentially mean that dominance may not be as dominant in the future. And I think that's certainly in the cards. I also think that, to your point about looking at the twin deficit of other countries, because it's a relative trade, right? I mean, it's if the dollar is bad and because the twin deficits in the US are bad, then, but it's bad, but is it as bad as it is in Europe? Is it as bad as it is in Japan? And the answer for that question usually is highly linked to being or not being a resource economy. Resource economies are likely to be very favorable in this setting that we're probably going to see. Meaning, countries like Brazil, countries like Australia, may actually, or even Canada, may benefit tremendously relative to developed economies that are actually net buyers of commodities, like China, like India and others. And so I am very bullish on emerging markets that are resource-rich economies, which when I say emerging markets, people immediately think about BRICS. I hate BRICS because I can see that there is a big separation of BRIC economies that are not resource rich economies at all. China is a great example of that. And I'm talking about on the large scale. I understand it's got rare earth and some other things, but on the large scale of things, you cannot say that China is a richer commodity-led country relative to a place like Brazil. And so this is going to create some interesting opportunities in FX markets where, let me give you an example, buying Brazilian real versus the Chinese yuan, or buying the Brazilian real versus the Japanese yen. I think those are all interesting trades in general. South American businesses that will likely, South America in general is very resource rich, but also very unexplored. And so as we see this all developing, I think a lot of those, that part of the world will be much more explored in 5 to 10 years. We'll create much better partnerships with developed economies that are in need of those resources. And so I'm really bullish in a lot of those, and why we've been investing so heavily in South America. So I think that's what's going to be the big change is looking for those differences of economies over time. So I'm quite concerned about the U.S. dominance in general, but more than anything, I think gold is going to play more and more of a role. You think about central bank assets and how they, a central bank likes to enhance the quality of their reserves in order to create credibility for their own currencies. So, it's just like, if you own, a stack of a lot of paper in your house, and another person has a stack of gold, which one would you rather choose? And I would choose the gold side. It's the same actually with governments that are owning a bunch of treasuries versus gold. It's essentially that comparison that you're making from a monetary perspective. Would you rather own a currency that, in order to back that monetary system, owns a bunch of gold, or owns a bunch of U.S. treasuries and others? And so that concept is starting to become more and more prominent in economy, in global economy. And so as we see them manifesting as well, it will create opportunities for gold becoming a far superior choice relative to treasuries. And some people will say, well, what about Bitcoin? Well, no. For a large central bank that needs to hold a significant portion of their central bank assets in something, I don't think they're going to be buying Bitcoin. I think they're going to be buying gold because of the history of it, because of the size of the market, and the way it has been, for centuries used as a haven asset, not for 10 years, 15 years. And so, not saying that's a negative for Bitcoin or anything, but it's just not that replacement idea of Bitcoin and gold. Just seems to me so ludicrous and lack of understanding of history. And so, I would bet against that as well. I don't think that we're going to see Bitcoin above gold, let's say in 5 years or so. I don't think that's going to happen.
In terms of market cap
and relevance in the market. I think gold is going to surprise a lot of people. And I think gold is not going to be trading at 2,000. The problem with this is that we've been in a mentality of, what am I going to make 20% on gold and we'll be happy, and I can make 1,000% on Bitcoin. And this mentality of return, it's been so easy to make money over the last decade or so that people just think it's easy to double your money or have a 1,000% return on something. And it's like, it's mind-boggling because it's just not how the world works. We just had a period where interest rates were falling and the economy was growing and it was just perfect for investing. This is not the environment we're in. Interest rates are higher. The growth is not the same. And so if that's the case, then you have to readjust that expectation for returns. And I think if I could bet against that, I would, but I just don't know how. But I just think people are just so far off with ideas of returns that they're going to be really, this generation is going to be very frustrated with their expectations of making very extensive returns are likely not to be materializing anytime soon. And so those are my thoughts on all this.
I guess it also has to do with the period of quantitative easing that we've witnessed in the last decade, at least. That's been very favorable and made any, let's say, financials, sorry to say, a stupid person look like a genius with the investment. Mm-hmm. But talking about BRICS and also talking about gold, recently there's been speculations, I would call them rather like that BRICS would form a currency that is backed by gold. It's been recently negated or contradicted that it actually won't be the case, that it will not form a currency backed by gold, but that this is still still bad news for the dollar, because more than, I think, 40 countries want to join the BRICS alliance and thereby also depeg or detach from trade with the US dollar. And still use gold as a way to back themselves with certain funds or have at least a security, and thereby also increasing the balance of gold. What do you think of that in general?
Well, I think it's there is a potential for that to happen, certainly, and I think there is a bigger chance that rather than the creation of new monetary systems, it's going to be more of, in my opinion, it's going to be more involved with partnerships that are going to happen outside of the dollar system. I think that's likely to occur. But more than anything is just this game of accumulating an asset that will improve the quality of the monetary system. Because when you see an environment where interest rates are higher, it creates a lot of competitions for currencies, right? I mean, why would you buy the euro versus buying the US dollar? You're looking for the interest rate differential. You're doing the same with the Brazilian real and so forth. And so if you're trading currencies, when interest rates are getting suppressed over time, it is the volatility of FX goes to zero, essentially. And now in a world where volatility or I should say interest rates are much higher, structurally higher, which I think they will be structurally higher for a while, then it changes the dynamic of how we trade currencies overall, and it will become a lot more volatile over time as well. So, but I don't see, I think a lot of the resource-rich economies haven't realized yet their position in the global stage here. I think some of them are starting to. But I foresee that will happen in 3 to 5 years, and it's interesting. But even thinking about the valuation of buying a business in the U.S. versus buying a business in Brazil, why would you pay 3 times earnings in Brazil versus paying call it. In some companies, if you talk about technology, some of them are trading at 100 times earnings. And that just makes zero sense to me, right? I mean, so you can say, well, there's a government change, in Brazil, and maybe that's why, leadership it should be priced that way. And I would disagree severely, because we've had other regimes in Brazil led by Lula in the past, which I don't think it's a positive, it's a negative for the overall economy. And I'm talking about financially speaking, not my political views. And look, we've had great times. In early 2000s, Brazil did very well. Brazil was up 18-fold during 2000s to the late 2008 or 9. And so, that could potentially happen again in this environment where things are so cheap. And so I'm really bullish in Brazil in general. I'm not as I don't think this BRICS thing is currency will will change much of the. No, I think first we need to see volatility. This is the sequence of facts. I think it's going to be volatility first, some depeg of currencies and other issues that will cause then monetary discipline at some point. We're not there yet. I think there's more FX vol to be exploited. And then once that happens, I think some countries are going to be forced to either peg their currencies versus gold and other things. I think this is going to happen on the back of this decade rather than earlier, personally.
Okay, great. To conclude, because we're reaching kind of like the end of our your precious time, I'd like to focus a bit on the cycles of gold. You've also posted that history of gold cycles in the edition of the June investor letter of Crescat. And I think it would be interesting to also then thereby, based on all the things we've said, inflation, recession, the fact that we're entering really like an era that is favorable to commodities and resources, as you just mentioned. All those countries that have a lot of resources, this hard asset, the materials, are the ones that will elevate their currency. But also the role of gold then. And we've seen here, like there's a very nice chart that where you can see like the history of the gold cycle. I see it only go up, but how do you see it actually happening? In which circumstances do you see every increase in price or like the price action of gold happen over the next 10 years?
Oh, I think it's wouldn't surprise me if we're at $10,000 an ounce by the end of the decade or something like that. And I think it's possible to even go higher. But I think we're going to see an exponential growth of the price. That's usually what happens during a cycle, gold cycle or a secular move. I think we're at the very early stages of that. And that will be really the beginning once we see this breakout from prior highs. And we've had something called the triple top formation when gold really retested its record prices of the last 3 years or so. It hit that price twice or three times and it has respected that price. It didn't went through it. And this is just to me is just a normal period of markets just sort of getting ready to a much bigger move that will surprise a lot of people. I don't know what the catalyst is, but I can see a lot of things being part of this movement, very different than prior gold cycles. In the 70s, we really had two cycles before this one. I think it would be the 70s and the early 2000s, and both of those lasted for a decade. Markets basically went exponentially higher in prices for gold, and silver led the way, by the way, in a big way, especially in the 70s, a little less in the early 2000s. It created a commodity boom. So it wasn't just gold. It was energy. It was agricultural commodities. It was all sorts. It was copper. While people think about the cyclicality of those things and so forth, they were all involved in this gold cycle, but they're all different, right? And in the 70s, we have accumulation of gold by the central banks, which is similar to today. There was a highly inflationary environment, which is similar to today. We had a lack of discoveries of gold at that time. It's similar to today. Then you look at the early 2000s, central banks were not buying gold, which is interesting. We didn't see an inflationary environment, which is also interesting, but we did see gold being very cheap relative to financial assets, which is similar to now. Meaning, you look at equity markets and valuations versus where gold prices are trading. Pretty interestingly, they were at an extreme, historically speaking. Another thing that was happening back then was that China was entering the WTO. There was a demand, being created by a country that was trying to become the manufacturing plant of the global economy. And today, what if that happens across most G7 economies? What if Europe cannot rely on China anymore? They have to have their own manufacturing plants. What if Japan is doing the same? What if the US is going to do the same, or Canada and Australia and so forth? If in the early 2000s, this was all created by one economy, imagine if the G7 economies have to do the same today. to me, that's a really plausible, potential explanation for what we could see here. The fact that a lot of endowment funds, large capital allocators, they traditionally have been running a portfolio with the 60-40 allocation that we call, right? With large exposure to equities and bonds. Well, what if bonds are not the protector of assets, of equities, and now you have to shift it away from bonds into gold? I think that would create a huge influx of capital for gold itself. So, or the central bank trend of them continuing to buy the metal over time. Is that a beginning of something or the end of one? I think it's the beginning. And so, boy, there's so many, different ways to be bullish on gold right now. The optionality of this is really attractive. I'm really excited. I think we're going to see a gold cycle this time. It's going to also be pushing commodity prices, in my opinion. Overall commodity prices. Businesses that are involved with that are going to do very well, and this is where I want to. Countries that are involved with that will do very well, and I'm much more interested in spending my time and capital on that than in AI technology and all those mega cap names that are excessively valuations right now.
Historically, we've seen a lot of gold confiscation in history, especially in times of either war or financial repression. We see that due to the problems of debt that we have, deficits and so on, that also the gain of control and the role of governments is more and more present in financial markets. Could we say that there's a risk, just like there was in 1933 in the US, 1959 in Australia, and more recently in 1966 in the UK, some sort of a ban or increase of financial repression, especially towards gold being also that one precious asset that is outside of the financial system and seen as a safe haven?
Well, look, let's just say, this is why I'm not a gold. I don't call myself a gold bug, but I think that's in the sequence of events. First, we need to see gold really rise, which would be caused by the lack of confidence in folks across their own monetary systems, and if that's the case, then governments will do what you just said. We just haven't seen that to the degree that I think we're going to see. Gold is at $10,000 an ounce, $15,000. Yeah, the risk of that is going to increase drastically. There is a risk of that today, but I think it's low, very low. It would surprise me if we hear gold being confiscated, in the US, like we saw in the 30s and so forth. I would be surprised if this happens now. We just haven't seen that pressure on the dollar like, I think we could potentially see. And I'm talking about relative to tangible assets. I think we need to see that first. Once we see that, I'm going to be very concerned. Probably won't be as involved as I am. Probably won't be talking about gold as positive as I am. Although I love the hard money concept and so forth, it doesn't mean I would be an investor of the gold space. But right now, I think it's one of the most interesting setups that I've seen in my career, when gold prices are about to start a secular move, and the businesses that hold gold either in the ground or have been producing gold are basically at historically cheap valuations. It makes no sense. And so I've been focused in that part because I love something that is unloved. And I think that's certainly the case here. So that part of it is where I spend most of my time today. And so, I think the sequence of events is going to lead to that, to your conclusion at some point. But I don't see the risk of that being too high. Some countries, sure. Yeah, I mean, there's some countries that are seeing already their currencies completely lose, faith by investors and population relative to gold. And sure, that could be a risk. But we need to see that first.
Mm-hmm. With also,
in
of
developed
course,
economies.
of course, like the looming risk of CBDCs as well. That could also maybe be an option for most central banks to increase that control over people.
Yeah, I'm a little less concerned about that being an alternative versus gold, but I agree with you. Yeah.
Why
There's
not?
going to be, because I think it's nothing different than the treasury, instrument. We all know it's going to be highly linked to a government-based institution. It's not going to be Bitcoin, right? It's not going to be an independent type of asset that is neutral and not linked to any level of government intervention. So to me, I think it's going to be pretty clear that, we can go to, CBDCs and so forth, just like we created treasuries, a whole treasury market. Yeah, I think that's possible. Now saying that that's going to steal the lunch of gold, I think people are smarter than that. I think institutions are smarter than that. I don't think institutions are going to be, I would rather own a CBDC versus a gold bar or anything like that. I'm not in that camp at all, but I could be surprised, but I don't think that will be the case. I think Bitcoin is a much bigger risk to gold than CBDCs. Let's put it that way. And I also don't share the view that Bitcoin, Bitcoin has a higher, a bigger room to grow. Obviously, it's like talking about a small AI company versus NVIDIA today, right? NVIDIA already had a run. If you're looking for a home run, would you buy NVIDIA or would you buy the small business with huge risk, but also huge return potentials? Yeah, that's, that would be Bitcoin. So it's or if you buy in Brazil today, if Brazil does very well, Argentina is going to do very well, most likely. And why? Because it's a higher risk version of Brazil. It's got a lot of resources. But if Brazil doesn't do well, boy, get ready. So, I think it's just as simple as that personally, but I'm sure I could be wrong on something here.
Okay. Cool, clear. Thanks a lot, Tavi. We're reaching the end of this interview. Where people can follow you, of course, on Twitter. And Crescat Capital, as I mentioned also earlier, releases monthly letters they can download for free and has a lot of valuable information, just as I have spread and scattered all over this this desk right now. Do you have any final thoughts or comments or things you want to share?
No, I just think, well, thanks for having me, first of all. No, I just think that this is, we're in an inflection point of the economy right now. And, I think it's really difficult when I think investors see other folks making a lot of money on technology and other things. And it tends to draw you into those sectors that are so expensive and so forth. It makes you believe that maybe there's something I'm missing and so forth. But that's just the usual process of macro and how confused you can get at times when we're at inflection points. And so, I would urge people to pay much more attention to the bigger trends and think about your investments on a risk reward basis. It's not the fact that something has outperformed gold or outperformed oil or anything like that, that is likely to be the case in the next 5 to 10 years. If something has been very unloved and has underperformed the market for the last decade or so, that should be in your radar. That should be something you should be studying and understanding if there's a case to be made that things will change. I think that's where a lot of investors make a lot of money, is finding contrarian ways to invest their capital. And that's certainly where I spend most of my time, not on what conventionally has been said on TV or newspapers and so forth.
Great. Thanks for coming, Tavi. I appreciate your precious knowledge and time.
My pleasure. Thanks for having me.
Thanks for watching. If you liked this episode, give it a like and don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.